Welcome back to the deep dive. Today we are not just talking about a stock ticker.
Yeah, definitely not.
We are really talking about the tectonic plates of the global economy shifting right beneath our feet.
That's the best way to put it, yeah.
So just to set the stage for you listening, it is Friday, February 27, 2026. And if you are looking at your portfolio this morning or just doom scrolling the financial news, you're seeing a paradox that pretty much defines our current moment in history.
It is the paradox of perfection.
Exactly. You're talking about NVIDIA, the absolute giant in the room. Right now, we're looking at a company with a market cap sitting nearly at $4.5 trillion.
Which is just, it's a number that's hard to even wrap your head around.
Right. Just to put that in perspective for everyone right off the bat, 4.5 trillion is larger than the entire GDP of Germany.
Yeah.
And they just reported earnings yesterday. And by every traditional metric, I mean, they didn't just beat expectations, they absolutely obliterated them. Record revenue, record margins, record guidance.
It was, on paper, the perfect quarter. The kind of quarter that usually sends a stock straight to the moon.
And yet the stock dropped.
It did.
It fell 5.46% in a single trading session. We are sitting at around $185 per share right now. And the mood in the market, it isn't celebration. It's anxiety. It's jittery.
It's the hangover effect.
Yeah.
We are at this really fascinating inflection point in early 2026. For the last 3 or 4 years, the entire narrative has been about training. Building the brains of these AI models,
Yeah.
buying the H100s, buying the Blackwell.
Right, the massive data center buildouts.
Exactly.
Yeah.
But now the global economy is trying to shift to inference and agentic deployment. The question investors are asking today, and really the reason the stock dropped is, well, is the easy money gone? Is gravity finally kicking in?
Or is this price drop actually a gift?
Right. Is $185 a margin of safety for the most important company on Earth?
And that is the mission today. We are going to strip away the hype. We aren't fanboys today. We are value investors. We are going to look at this Silicon Fortress and analyze the moat, the management, the financials, and the very real geopolitical risks that are looming over the Pacific.
And I'll tease our conclusion right up front for you. What we found in the research is a classic value investing dilemma. We are looking at a truly wonderful company, maybe the best business model we have ever seen, but it is trading at a price that leaves effectively zero room for error.
Zero room for error. That is a very high-stakes game. So let's get into the machinery.
Let's do it.
Part 1. Chapters 1 to 3. Business, management, and financials.
I'm ready to break it down.
Chapter 1. Business understanding.
We have to start with a fundamental shift in how we even define this company, because I think even here in 2026, people get this wrong.
There is still this lingering idea that NVIDIA is a chip company.
Yes.
That they make the graphics card that goes in your kid's gaming PC. But looking at the breakdown of this quarter, that definition feels almost dangerously outdated.
It is completely obsolete.
Yeah.
If you are analyzing NVIDIA as a chip maker, you are analyzing the wrong business.
Yeah.
In 2026, NVIDIA is an accelerated computing platform.
Right.
The best analogy I've come across in the research is to think of business as a game of chess. Most companies, even the great ones, they're thinking 1, maybe 2 moves ahead. NVIDIA has spent the last decade positioning its pieces so that every single move a competitor makes, whether it's Google, AMD, Intel, it eventually leads to a checkmate for NVIDIA.
The grandmaster strategy.
Exactly.
But let's look at the cash register. Where is the money actually coming from now? Because it's not the gamers anymore.
No, it's the data center. We have the fiscal year 2026 numbers right here.
Yeah.
Data center revenue is now 89.7% of their total sales.
Wow.
We are talking about $193.7 billion coming just from that one segment.
Nearly 90%. So the gaming side, the GeForce cards that literally built the brand.
That's just a rounding error now.
Financially, yeah.
It's a very profitable side hustle, but it's no longer the engine. The engine is systems selling. And this is a crucial distinction for you listening. NVIDIA isn't just shipping a box of chips to Microsoft anymore. They are selling entire liquid-cooled racks.
Explain that visual. What does a rack look like in this context? Because it's not just a shelf.
No. Imagine a massive server cabinet, roughly the size of a refrigerator, but packed with incredible density. It contains the GPUs, yes, but also NVIDIA's own Grace CPUs, their own memory, and crucially, their InfiniBand networking cables.
So they own the whole stack.
They own the compute, the memory, and the transport layer. You don't just buy the engine from them, you buy the entire car, and you buy the road it drives on.
Which locks you in. I mean, you can't just swap out a part from AMD chip if you bought the whole integrated system.
Exactly. It creates immense stickiness.
Mm.
But there is a new driver in 2026 that we need to spend some time on because it's fascinating. Sovereign AI.
This term has been popping up everywhere in the notes. Sovereign AI. It sounds like something out of a cyberpunk novel or a spy thriller. What does it actually mean for the bottom line?
It's the realization by nation-states that intelligence is a natural resource. Look at Japan, France, Singapore, Canada. These governments have realized they cannot rely on American tech giants for their intelligence infrastructure.
Right. They don't want their culture, their laws, their history filtered through a model trained in San Francisco.
Precisely. They want data sovereignty.
So they're building their own AI factories.
Correct. They are funding domestic supercomputers to train models on their own languages and their own cultural data. And here's why that matters so much for NVIDIA. The customer is no longer just Mark Zuckerberg or Satya Nadella. It is the Prime Minister of Japan. It is the French government.
And nation-states have very different pockets than corporations.
Deeper pockets and entirely different motivations. A corporation worries about quarterly return on investment. A nation-state worries about national security and economic survival. They will spend whatever it takes to not get left behind. That is a massive, price-insensitive tailwind for NVIDIA that the market is still trying to quantify.
Now let's talk about the hardware itself. We are currently in the Blackwell cycle, but the report mentions the Rubin era beginning. What is happening with the product timeline?
This is a masterclass in strategic acceleration. Historically, the chip industry moved on a tick-tock cycle, a new architecture every 2 years.
Moore's Law, basically.
Right. But Jensen Huang looked at the demand curve and said, that's too slow. He compressed the cycle. They are now on a 1-year cadence. We had Blackwell in 2025. Now in 2026, we enter the Rubin era.
Speed kills the competition.
That is the reset strategy. Think about it from the perspective of a competitor like AMD. You spend 2 years designing a chip to beat Blackwell. You finally launch it. But the day you launch, NVIDIA releases Rubin, which is twice as fast. You are perpetually chasing a ghost. You are always 6 to 12 months behind.
It's like trying to race Usain Bolt, but every time you get close, he jumps on a motorcycle.
A motorcycle that is 10 times more efficient. And that is the key selling point of Rubin. It is designed specifically for agentic AI.
Okay, stop there. Agentic AI. We hear this buzzword a lot. Define that for the listener who isn't a computer scientist. How is that different from the ChatGPT we used back in 2023?
So up until recently, we've had chatbot AI. You ask a question, it gives an answer. It's a call and a response. Agentic AI is software that can reason, plan, and execute. You don't ask it a question, you give it a goal.
Like what?
Like you say, plan a travel itinerary for my team, book the flights, reserve the hotels, and email the confirmation to these 3 people. And it goes off and does it. It acts as an agent.
And that requires a lot more thinking power from the chip.
Massive amounts. It has to think through multiple steps. This is called inference. And right now, inference is too expensive. If I have a billion agents working for me, I can't afford to pay $1 for every thought they have. The Rubin platform offers a 10x reduction in the cost of running these agents.
So NVIDIA isn't just selling speed. They are selling the economics of the future workforce.
Precisely. They're making it economically viable to deploy trillions of AI agents.
Yeah.
That brings us to the moat. We always talk about moats in value investing. Is it just that their chips are faster?
I assume it's more than that. Speed is a commodity eventually, right? Someone always builds a faster car.
Speed is a fleeting advantage. The real moat is twofold. First, it's TCO, total cost of ownership. NVIDIA chips are incredibly expensive up front. They cost a fortune. But they are so energy efficient that over a 3-year period, you save money on electricity.
Because power is the bottleneck now.
Exactly. In 2026, the world is power constrained. Data centers literally cannot get enough electricity from the grid. So saving power is just as valuable as raw speed.
It's the MPG argument. You buy the expensive hybrid to save on gas over time.
Right. But the second part of the moat is the famous CUDA toll bridge.
CUDA. This is the software language.
It's the software layer that allows developers to talk to the GPU. NVIDIA has spent 15 years cultivating this. Millions of developers have built their entire careers on CUDA. All the scientific libraries, all the AI frameworks, they are all written in CUDA. To switch to a competitor, a company would have to rewrite its entire software stack.
That's the switching cost. It's
Yeah.
like trying to get an entire country to switch from driving on the right side of the road to the left. Theoretically possible, but a logistical nightmare.
It's a massive barrier. And there's one more barrier mentioned in the notes, pre-booking TSMC.
This is the manufacturing side over in Taiwan.
Yes. These chips require a very specific advanced packaging technology called CoWoS, chip on wafer on substrate. It's incredibly hard to do. NVIDIA has largely pre-booked TSMC's capacity for this through 2027.
So they just bought up all the factory time?
Yes. So even if a competitor designs a better chip, they literally might not be able to build it because NVIDIA has cornered the manufacturing capacity.
That is ruthless and
Yeah.
brilliant. Which brings us to the person making these decisions.
Let's talk about him.
Chapter 2, Management Evaluation.
You cannot tell the story of NVIDIA without talking about the man in the leather jacket, Jensen Huang.
The captain.
Yeah,
He has been at the helm since founding the company in 1993.
which is incredible. That tenure is incredibly rare in tech. Usually the founder gets pushed out, or they retire, or they just lose their edge. But what defines Jensen isn't just longevity, it's his ability to bet the entire company on inflection points.
We saw that with the 2022 pivot, right? I remember that clearly. Crypto had crashed, gamers were furious about chip shortages, the stock tanked. It looked pretty bleak.
It was a brutal time. Revenue from gaming fell off a cliff. Most CEOs in that position would have cut costs, played it safe, tried to weather the storm and appease Wall Street.
But Jensen did the opposite.
He took the inventory hit, and he poured every spare dollar into the H100 GPU for AI. This was before ChatGPT had even launched publicly. He was effectively betting the company that generative AI was about to explode.
It's that ability to see around corners, and the culture there seems to reflect that intensity. They call it a speed of light culture.
Yes, it's a very flat organizational structure. Jensen famously has about 50 direct reports.
50. That sounds like a management nightmare. Traditional theory says you should have, what, 5 or 6?
It is highly unconventional. But the logic is that he doesn't want information filtered through layers of middle management. He doesn't want the telephone game where the message gets diluted by the time it reaches his desk. He wants to hear the raw data from the engineers and the VPs directly so he can make decisions instantly. It prevents bottlenecks.
Let's talk about how they handle all this money they're making. Capital allocation. Because they are swimming in cash.
They're generating cash faster than they can figure out how to spend it on R&D. In fiscal year 2026, they returned about $41 billion to shareholders.
Mostly buybacks.
Almost entirely buybacks. About $40 billion in stock repurchases and less than $1 billion in dividends. They clearly preferred to reduce the share count rather than hand out cash dividends, but the metric that really matters here, the mic drop metric as you called it, is ROIC, return on invested capital.
Break that down for us. Why is that the holy grail metric for value investors?
It measures how efficient a company is at turning cash into more cash. If you give a company $1, how much profit do they generate with it? The average S&P 500 company has an ROIC in the low double digits, maybe 12 to 15%. If you are really good, maybe 20%.
And NVIDIA?
NVIDIA's estimates for early 2026 place their ROIC between 76% and 99%.
99%. That shouldn't be physically possible.
It indicates extreme efficiency. For every dollar they put into the business, into factories, into talent, they're generating almost $1 of return annually. It is, effectively, a money-printing machine.
But it's not all perfect. We have to touch on the ethics and transparency. The CFO, Colette Kress, is generally well regarded, providing really disciplined commentary. But there is this question of circular investment.
This is a nuance that bears watching. NVIDIA has a venture capital arm. They invest in AI startups. Sometimes they invest in a startup, and then that startup uses the investment money to buy NVIDIA chips.
So I give you $1, and you use that dollar to buy a lemonade for me. Did I really sell a lemonade?
Technically, yes. Legally, yes. It's called investment-led demand. But it does raise eyebrows.
Yeah.
It creates questions about the organic sustainability of revenue. If the venture capital money dries up, does the demand for chips dry up too? It's a risk factor that adds a layer of fog to the numbers.
Chapter 3, Financial Health.
Let's get into the hard numbers. The scorecard.
We talked about revenue, but the growth trajectory is just hard to wrap your head around.
It's hypergrowth at a scale we haven't seen since the early internet boom. But the absolute numbers are staggering. Fiscal year 2022 revenue was $26.9 billion. Fiscal year 2026, it is $215.9 billion.
That is nearly a 10x increase in 4 years for a company that was already huge.
And look at the gross margins. 75% in the most recent quarter.
For hardware, that sounds like a software margin. Usually if you make physical things like cars, phones, refrigerators, Your margins are lower because you have materials, factories, shipping costs.
That is the key insight. 75% margin means for every dollar of sales, 75 cents is profit after making the product. That is software territory. It proves that NVIDIA isn't selling a commodity. They're selling a monopoly product that customers are willing to pay any price for.
Yeah.
They have pricing power that is virtually unheard of in hardware.
What about the balance sheet? Is it safe?
It's a fortress. They have roughly $60.6 billion in cash and marketable securities. Their debt-to-equity ratio is 0.06.
0.06, so basically no debt.
Effectively zero. They are financing everything through their own earnings. There's a metric called the Altman Z-score, which measures bankruptcy risk. Anything over 3 is considered safe. NVIDIA is at 72.06.
Okay, so they aren't going bankrupt next week, but are they expensive? Let's talk valuation. This is the math problem every investor is trying to solve right now.
This is where the divergence happens. On a relative basis, the stock is trading at 45 to 50 times forward earnings. That is high. The market average is usually around 20. But for a company growing this fast, 50 times is arguably justified. The PEG ratio, price-to-earnings growth, is actually quite reasonable.
But what about the intrinsic value? If we run a discounted cash flow, a DCF, what is the stock actually worth based on future cash?
This depends entirely on what you believe about the future. If you run a DCF with a base case, assuming growth slows down to, say, 15% after this initial data center build-out, the value comes out to around $123 per share.
And the stock is at 185. So that model says it's way overvalued.
Right. But if you look at the bull case, assuming agentic AI causes a second massive wave of investment and growth stays higher for longer, the value could be $240 per share.
So we are sitting at 185, right in the middle.
Exactly. The current price reflects the market's uncertainty. It's hedging its bets between the party is over and the party is just getting started.
Part 2. Chapters 4 to 7, market sentiment, ownership, risk, and final conclusion.
So we have the numbers.
Chapter 4, market sentiment.
Now, let's talk about the vibes. The hangover.
It really feels like a hangover. You wake up, the numbers are great, but your head hurts. The drop on February 27th was fascinating because it showed that good isn't good enough anymore.
The market had priced in perfection. When NVIDIA reported a record beat, the traders essentially said, we wanted a bigger beat.
It's that expectation treadmill. You have to keep running faster just to stay in the same place. And there is some genuine macroeconomic fear out there, too. I saw the news about Block.
That was a significant signal. Block, formerly Square, announced they were laying off 4,000 people. And they explicitly cited labor-saving AI as the reason.
That spooked the market.
It did, because it validates the AI deflation thesis. The fear is that AI might cause a recession before it causes a boom. If companies fire people to replace them with NVIDIA chips, consumer spending might drop. Unemployed people don't buy iPhones or Teslas. That rattled investors who worry about regulatory backlash. If AI starts taking millions of jobs, will the government step in and regulate NVIDIA?
Despite the fear, the analysts are sticking to their guns.
Overwhelmingly. Out of 66 analysts covering the stock, 61 have A-Tray ratings. The average price target is around $255. So Wall Street is saying, ignore the noise, buy the dip.
And the short sellers, the people betting against it.
They are practically non-existent. Short interest is only about 1% of the float. The smart money is terrified to short Jensen Huang. It's been a widowmaker trade for a decade. Anyone who bet against NVIDIA in the last 10 years lost their shirt.
Let's look at the technicals quickly. For the traders listening, where is the floor?
The stock is searching for it. It broke below the 50-day moving average at $190, which is a bearish signal. It means momentum has stalled. But it is testing the 200-day moving average at roughly $186.
That 200-day line is crucial, right?
It's the long-term trend line. It's the line in the sand for institutional algorithms. If it holds 186, it's a healthy correction. If it breaks significantly below that, we could see a rush for the exits. However, the RSI, the Relative Strength Index, is near oversold, so a bounce is statistically likely here.
Chapter 5, ownership structure.
Who actually owns this $4.5 trillion beast?
It's the giants.
Yes. Institutional ownership is around 70%. The top holders are exactly who you'd expect. Vanguard owns 9.3%. BlackRock owns 8%.
So almost 20% of the company is just 2 asset managers.
Yes. And the top 4 firms combined hold nearly 25%. This is a double-edged sword. On one hand, it provides stability. Vanguard isn't going to panic sell because of one bad news cycle. They're passive holders. But on the other hand, it creates concentration risk.
Explain that risk for the listener.
If there is a liquidity crisis, or if regulators force a rebalancing and BlackRock has to dump even 1% of its stake, that is billions of dollars of selling pressure. It would crush the stock price instantly. The exit door is very small when you're that big.
What about the insiders, the people running the show? Are they buying the dip?
No, they are selling.
That's never what you want to hear.
In the last 90 days, executives, including CFO Colette Kress, sold about $292 million in stock. Now, to be fair, we have to nuance this. A lot of this is 10b5-1 plans.
Define that.
It's a pre-scheduled selling plan. You set it up months in advance to avoid accusations of insider trading. It's for diversification. If your entire net worth is in one stock, you want to sell some to buy a house or diversify into bonds.
But the price point still matters.
It does. They were selling in the $180 to $200 range. That suggests management views the company as fairly valued. If they thought the stock was going to 500 next year, they might hold on. But they are taking chips off the table. It signals they don't see the stock as deeply undervalued right now.
Chapter 6. Risk assessment.
We've talked about how great the company is. Now let's talk about what could kill it.
Let's do a SWOT analysis. What are the weaknesses and threats?
The biggest weakness is concentration risk. We said 90% of revenue is data center. If that slows down, the stock collapses. There's no backup plan that generates that kind of cash. Gaming cannot save them.
And the manufacturing.
Total reliance on TSMC in Taiwan. If anything happens in Taiwan, geopolitically, or even just a massive earthquake, NVIDIA stops existing as a functioning business for months. They have no other factory that can make these chips. They are fabulous.
And speaking of geopolitics, we have to talk about the Trump tariffs of 2025.
This is a major headwind in 2026. The administration invoked Section 232 tariffs. That imposes a 25% duty on certain AI chips.
So it's a tax on innovation.
Essentially, it makes AI more expensive for everyone. It suppresses demand at the margins. But the bigger geopolitical issue is the China problem.
The report says revenue from China was 0 in the data center segment.
0. That is a stark, terrifying number. Due to the export bans on high-end chips like the H20 and the new 15% revenue tax requirement on approved exports, NVIDIA has been effectively locked out of one of the world's biggest markets.
That's billions of dollars left on the table.
Estimated at $5 billion to $10 billion annually. It's a frozen opportunity. But the danger isn't just lost revenue. It's that Chinese firms are now forced to build their own substitution products. By locking NVIDIA out, we're inadvertently funding the creation of their competitors. Huawei and others are filling that vacuum.
So we are creating a rival where there wasn't one before. And speaking of rivals, they are popping up closer to home too, the hyperscalers.
This is the frenemy dynamic. Microsoft, Google, Amazon, they are NVIDIA's biggest customers. But they are also building their own chips. Google's TPUs, Amazon's Trainium, Microsoft's Maya. Because NVIDIA's margins are so high, that 75% we talked about, it incentivizes these huge companies to build their own hardware to save money. Every chip Amazon builds for itself is one less chip they buy from Jensen.
It's the Netflix problem. Disney used to sell content to Netflix, then realized they should just be Netflix. Now Amazon realizes they should just be NVIDIA.
Exactly. Over time, that will erode NVIDIA's pricing power.
Chapter 7. Conclusion.
Okay, we've looked at the fortress from every angle.
The incredible moat, the genius management, the insane financials, but also the tariffs, the China risk, and the insider selling. Let's bring it all together.
We have to synthesize this for the listener.
Give me the bull case first. Why should I buy at 185?
The bull case is that we are in the early innings of a new industrial revolution. Agentic AI is real. It will drive a hardware refresh cycle that pushes revenue to $300 billion or more. The moat, CUDA, is impenetrable for at least another 3 to 5 years. The stock is oversold technically, and an ROIC of 90% means you are owning the most efficient capital compounder in history. You buy it, you hold it, you get rich.
And the bear case?
The bear case is the law of large numbers. You cannot double revenue every year forever. It's mathematically impossible. If growth slows to even 20%, a 50 times PE ratio is way too high. The stock could get cut in half to that $123 intrinsic value we calculated. Tariffs and the loss of China are permanent anchors dragging on growth, and the hyperscalers will eventually succeed in moving some workloads away from NVIDIA.
So what is the verdict?
The verdict is that NVIDIA is a wonderful company at a fair price. It is not a bargain. It is not a steal.
No margin of safety.
None. If you buy here, you have to believe in the supercycle. The drop to the 200-day moving average at $186 might be a good technical entry point, but only if you have a 5 to 10-year horizon. If you're looking for a quick flip, the risk-reward is very murky.
It's a classic dilemma. You have to pay up for quality.
Exactly.
Mhm.
But I want to leave you with one final provocative thought.
Let's hear it.
We've been valuing NVIDIA using traditional metrics, PE ratios, DCF models. But think about sovereign AI and agentic AI. If this technology truly becomes the primary economic engine of nations, if it becomes the primary labor force of corporations, does a PE ratio even apply anymore?
What do you mean?
I mean, we don't look at a PE ratio as the concept of electricity. We don't value the internet based on next quarter's earnings. If NVIDIA is building the utility grid for the 21st century, the actual infrastructure of intelligence, maybe we are underestimating it because we are using 20th century rulers to measure it.
That is something to chew on. Are we valuing a company or are we valuing the new electricity?
That's the trillion-dollar question.
Well, on that mind-bending note, we are going to wrap up this deep dive into the Silicon Fortress. Thank you for listening.
Thanks for having me.
This analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.